Hey everyone, and welcome to this course. In this course we are going to be discussing the value investing strategy and to teach you how you can trade stocks yourself. Now, just before we dive right in, the value investing strategy is a phenomenal tool that is used by many of the world's most famous investors, including Warren Buffett. In this course, I would like to teach you how to value invest. My name is Kyle Kildare, and without further hesitation, let's jump right in. So what is the goal of the course? The course will provide you with a step-by-step guide to help you set up your investing account, teach you the basics of value investing, improve your knowledge with real-life examples, leading finally to the end goal that you will be able to invest your own money confidently. I wanted to create a course on value investing because it is a successful strategy which has helped many famous investors such as Warren Buffett, Peter Lynch, and Benjamin Graham beat the market. I hope this course can help you do the same. This course was created to teach you value investing. Before I can teach you value investing, I need to first teach you what investing is. Why should you invest? It is quite simply a phenomenal way to generate a great sum of money in the long term. To explain the statement, let's assume you had invested $10,000 in the S&P 500 index at the beginning of 1950. The S&P 500 index is a collection of all the stocks and shares of the largest 500 companies in the United States of America. What would that be worth at the end of 2010? So 60 years later. Take a guess. $100,000, $500,000, maybe $1 million. It would have turned into $5 million. This brings me to my first quote. Compound interest is the eighth wonder of the world, by Albert Einstein. The point of this beginning series is to just give you an idea of how powerful investing really is. So, what is investing? Investing is a process of taking one's money and investing it into a company. Every company in this world needs to first be created. This is done when the owner or owners register the company with the relevant authority in one's country. Upon registration, the owner or owners of the company are provided with a share certificate. These share certificates allow one to determine how much they own of a company. Whenever a company is registered, the founders have to determine how many shares they want the company to be made of. If, for example, you have two friends, Dan and Nick, who want to start a business, when they go to register the company with the relevant authority, they decide that they want their company to be made up of 200 shares, with each person getting 100 shares. These 200 shares are what we call the total number of shares issued by the company, or the total number of shares outstanding. Anyway, given that each person gets 100 of the 200 shares issued, this means that for both Dan and Nick, they each own 50% of the company, i.e. the 100 shares that they each receive divided by the 200 total number of shares issued. The point is that these share certificates merely determine how much of the company one owns. This brings us to the first principle of value investing, and that is that a share purchased represents a portion of the company actually owned. It represents a physical piece of an enterprise. When you purchase one share from Microsoft, that means that you actually own a portion of the Microsoft company, the same way Bill Gates owns a portion of Microsoft. There are multiple words for shares. Some people call them equities, stocks, securities, or just shares. The important piece to take from this opening is that a share is not a ticker symbol, which can go up or down, like many of the Wall Street TV presenters like to make you think. It is an actual business which you own a portion of. So, as an investor, you are someone who purchases shares in a company. Before we go further, it is important that I emphasize the following distinction. An investor is someone who invests in a company after thorough analysis of that company. If you put money into a company in the hope that the share price goes up, you are not an investor, you are a speculator. A speculator is no different to a gambler. Speculation is outside of the scope of this course. I'm here to teach you how to be a wise value investor, someone who only invests in a company after thorough analysis of the business and what it is worth. We will get to that in a later stage, but it is crucial that the distinction is made upfront. Now, how do you purchase these shares? We shall discuss this in the next lecture. Just before you rush over there, I have attached an interesting article that covers the power of investing. I highly recommend you give it a read.